Let's get in. Seth Freeman, Senior Managing Director at Glass Ratner, joins us right now on the show. Seth, good having you. Thanks much for taking the time out. You reckon Jerome Powell will sound a lot more dovish than what the markets would have thought before the minutes came out?
Well, I expect him to be fairly dovish. It was positioned right now, at least as a kind of one-time recalibration movement. And it's just not clear that we're going to see a series of cuts.
Okay. In light of this, Seth, with an assumption that Jerome Powell does sound mildly dovish, and a lot of people believing, or a lot of global websites believing that he's already behind the curve. I read a couple of opinion pieces overnight. Just wondering, what do you think happens to the markets in the near term? Because everybody's seems to be bracing themselves for a possible recessionary move in 2020, but believe that the markets will not quite give in just as yet.
Well, it's quite clear that we're looking at a global slowdown, but typically the curve, the inversion, has been looked at as a sign of a coming recession. But it's been pointed out that the yield curve has been relatively flat for some time, and we also have much more dynamic global flows. So it's not being held out, at least this week, as being the indicator of a looming recession. The U.S. economy is relatively strong, and it's consumer driven. And in spite of additional retail Chapter 11s as recently as last week, consumers are spending. But at the same time, we are looking at a lot of uncertainty globally.
We are. Professor Aswat Damodaran of Stern, NYU, mentioned that we give the Fed a lot more, or we assume that the Fed has a lot more power than it actually does. If indeed that's the economic scenario out there, Seth, do you think dovish commentary, central banks cutting rates by itself might help economies? I mean, I think the IMF economists also put out this note that currency tinkering as well as rate tinkering will not necessarily help economic growth coming back. Does the Fed have the ammo to stave off what looks likely to be a spiral downwards?
Well, a spiral sounds pretty dire.
Okay, let me not call it a spiral.
Is the Fed has fewer and fewer tools when interest rates go down. And at the same moment, we're looking at relative currency strength. As you mentioned earlier, Germany sold negative yield bonds. And, these moves in other countries strengthen the dollar. And that makes our goods, less competitive. So it has a self-fulfilling type of process over time. And the real question is, are these, if the Fed was to continue to lower rates 25, 50 basis points, is that really going to stimulate the U.S. economy, or is all of this sort of baked in already?
Okay, then my final question, Seth, on this topic. Again, it's some bit of assumptions and guesswork out here, but if indeed we project a trajectory post the Jackson Hole address that the Fed likely will be more dovish, it doesn't do much to the economy, but does it do enough for the markets, and would people want to participate in that market? Yesterday we had a guest who said that the construct seems to be that if indeed the rates come off, irrespective of what happens to the economy in the near term, the markets may still rally. Is that a good base case assumption?
Well, the markets are forward looking. And if you look at the futures right now for tomorrow, they're relatively flat. So I don't think anyone's getting too excited. We also have to remember that the conference at Jackson Hole is really an academic conference. It's not a policy setting conference. And we should maybe listen to the nuances that come out from the speakers, but they're not going to be setting policy per se. And I think we're going to really have to wait until the next round of meetings, formal meetings, and as we get closer to the holidays and summer's over, we'll get a much better view, at least of the direction in the U.S. But we can see in other countries, whether it's Indonesia, Germany, they're responding to slowdowns in their economies.